How much of that stabilization needs to come from China?
Thanks for having me on the show, Heidi. So I think that actually a lot of that growth stabilization signal will need to come from China, which, as you mentioned earlier, is in the middle of a renewed COVID outbreak. We've seen about already 4 weeks of lockdown in Shanghai. This continues, could be for another 1 or 2 weeks. We're seeing a sporadic cases being reported elsewhere, but particularly in Beijing, where we're seeing mass testing. So that looks like will look like the prelude to some type of economic restriction, which could also hurt growth. So cumulatively speaking, we're still looking at, I think, next couple of weeks, continued downward revision in terms of growth expectations and earning expectations. So we started the year with a 4.5% GDP assumption, leaving some allowance for situations like this, just in case COVID really erupts. But I think that at this point, this even introduces some additional downside risk, let's say about 0.5 percentage point to our forecast. And hopefully, let's say if we see another 2 or 3 weeks of lockdown, but situations start to stabilize by the end of May, second quarter could be probably the worst quarter in terms of growth this year. And second half of the year, we could start to see more of that fiscal policy coming through slowly, which will help us to move growth expectation back up a little bit. But generally this year, I think COVID is still a pretty big drag on growth, apart from the other sectors that are also slowing, such as the housing market and obviously global export demand.
The Security Times, Julia, is saying that we could potentially see 2 more triple R cuts between 25 to 50 basis points each this year, and also that the PBOC has room to cut interest rates by another 20 basis points or so. If we see more swift action, is that enough to really put a floor under the volatility and give some more confidence to investors?
Well, I think that at this point, probably any policy type of support is better than no support. So from that perspective, having more from the policymaker side is definitely better for markets. But in terms of effectiveness, we've been in a camp that says, look, monetary policy is very dependent on the housing market in terms of its transmission mechanism, because the housing market accounts for almost half of credits in the system. And it's also a very key sector that transmits the effect of lower policy rate into the rest of the economy. By the middle of a massive housing market deleveraging, that traditional transmission mechanism isn't working out so well. So I think that's partly the reason that the PBOC has been quite cautious in doing monetary policy easing. So certainly, I think some further incremental policy signals are likely, given that clearly there's a lot of market expectation for it, but we really don't expect that to really shift the growth trajectory up a gear. I think you really need to see COVID subsiding first, and then maybe some fiscal support coming through.
With that divergence, though, when it comes to policy, how will that really react? How will the Chinese yuan react to that, and how does that set you up for what you like or don't in the equity space?
Sure. So we're of the view that the RMB could continue to weaken the next couple of months, mostly really based on some of the fundamental factors that are shifting coming into 2022. One being that clearly global export demand isn't quite as good as they were last year. We are looking at still a sizable trade surplus. We're probably down 20-30% from the very strong level that we saw in 2021. And secondly, of course, the big policy divergence, vis-a-vis the U.S. And thirdly, the fact that, in this current environment, you're seeing that stronger dollar is pushing every other currency to depreciate. So I do think that these fundamental factors warrant a weaker RMB. And that will help to relieve monetary conditions and provide some cushion for the economy as well. We do think the authorities will try to manage the pace, so we'll likely see a fairly managed pace of depreciation from here.
So, Julia, I see in your notes that you like Treasuries, especially 3 to 5 years or longer, which really sets us up for our End Life Pulse survey about the bond markets and the volatility there. Do you have any expectations of when that really uncertainty in the bond space will end?
Sure. I think that for long-term investors, we're looking at a picture where 7 to 10-year treasuries are approaching 3%. In a backdrop of very strong dollar, deterioration in global growth expectations, that's already looking like a fairly attractive package for long-term investors to buy into treasuries. And don't forget that if you ever head into a bad global environment, like a recession type of scenario, not our base case, but if you do, then treasuries offers a lot more upside in that scenario. So I think that the risk reward for treasuries already looking quite attractive, and particularly for more sophisticated investors, going into longer duration from 7 to 10 years is looking increasingly better. In terms of the absolute turning point, we do think that inflation is still quite key to watch, and preferably, seeing a peak in inflation probably around mid-year or slightly after that will be, I think, even clearer signal for a lot of investors.